Today, we have to talk about European energy and the US housing market. It seems weird that those two things would go together, but they're actually happening at the same time. I don't think one is necessarily impacting the other, but they are both impacting the stock markets around the world. So we have to talk about them today. Stick around. Hey everybody, this is RC Peck with my weekly update. There's two things we have to talk about today. We have to talk about European energy, specifically natural gas, which has to do with Russia and Ukraine, and really inflation. It's a pretty big story that's happening, and it didn't just start this year. And the other thing we have to talk about is US real estate, because it's not looking good. I'm going to start with real estate first. And I've done something a little differently. I have pulled charts from Twitter that I've noticed are interesting that really tell the same story. So the two price charts or the two pieces of information I want to start with is just kind of showing you what's going on the globe or on a global basis. This is from Cheddar Flow, and this is household incomes crashing worldwide. So this goes back to 75, global real disposable income. Now, a lot of this has to do with inflation, and that's the point. We have an inflationary thing going on worldwide, not just in the US, not just because the Fed printed trillions of dollars or expanded their balance sheet or the US government went into deficit spending, but this is a global view. This is real, real is a word that means adjusted for inflation. Disposable income year over year. So not looking good. This is kind of a global look. It's hard to look at each individual because it's such a small chart, but this is just showing you year over year inflation rates throughout the world. And the blue rectangle is the US, but also just kind of notice you have, Sweden at 8.5%. You have the Eurozone at 8.9%, right? You have the UK at 10%. You have the Netherlands at 10.3%. Spain at almost 11%. So this isn't just little teeny countries in South America that no one knows where they are or what their names are. This is developed countries throughout the world that are experiencing inflation. So it's a global phenomenon. It's not just in the US, it's not just in Europe, but that's globally. That's what I want to start with. Now let's look at a couple price charts or a couple charts about housing in the United States. Most of these are from Charlie BLO. And he's got, if you want to get good data, follow him on Twitter. He's such a clear thinker that I like a lot of what he reads. And whenever I see something by Charlie BLO, I click on it, I read it. So this is U.S. Housing Affordability Index going back to almost 1980, down to 1989 levels. Not good. So affordability, when houses aren't affordable, that's typically not good for the economy. This is home builder confidence. When home builder confidence is below 50, which it is now below 50, a couple things happen. Typically means, or it increases the likelihood that there will be a recession. And you can see the gray vertical bars are past recessions going back to about mid-1980s. And you can see when the blue line does drop below the horizontal red line, it's not good or greatly increases the probability of a recession. The other thing I want to point out is you have this big drop here with the COVID drop. It's now below that, right? So the home builder confidence is below COVID, meaning everything that happened, the money printing, job gains, job losses, net of everything. And we are now 2 years past the start of COVID. I kind of think of the start of COVID as March 1st of 2020. Things are not looking good for real estate. This is U.S. existing home sales. So home sales are also falling. Now, they haven't fallen below yet the bottom of the COVID bottom, but they are greatly falling off. Again, these vertical bars are recessions, and when they drop like that, it is not good for the overall stock market. So this is a real estate conversation and a stock market conversation at the same time. Now, here's the reverse of this information. This is from Redfin. This data is from Redfin. This to me is just crazy. Now, it's only back to 2015, so I don't know what it looked like in 2010 or 2005 or 2000 or 1985, but certainly over the last 7 years. Look at this. Mortgage payments. So this is the mortgage payment on a 4-week rolling average of the median asking price. Like, this is pretty crazy. I mean, this is amazing, right? Mortgage payments. This is pretty amazing to my brain that this is the median monthly mortgage payment in the US. That doesn't look sustainable, which I think drives to a lower price in real estate. So before I get to Europe, what I'm seeing is it's more than weakness in real estate. Real estate moves much slower than the stock market or the bond market or the commodity market. It can take days, weeks, months to sell a house. So the price changes move much slower through the market, but we are starting to see those price changes show up, not only in mortgages going up basically from 2.7% to 5.4% directionally, right? That's a big change. But now people, either they're not selling because their house has dropped greatly, buyers have given up, like buyer fatigue. But what it's showing is lower real estate prices in residential markets in the US. And for reference, the US residential real estate market is about $50 trillion. So it's a big impact. Okay, now let's get to Europe. This is a price chart of European natural gas. That's a spike. I mean, that is pretty incredible. This is March right here of 2020. So the beginning of COVID right there. Let's just call that about 9. And this is 92. So there's a 10x increase in natural gas prices in Europe. That's a big deal. Okay, this is electricity prices in Europe. So now I just went from natural gas, now I'm talking about electricity. So clearly the way that a lot of Europe gets their electricity is through natural gas. But look at that spike. I mean, this is pretty amazing. This reminds me of the 1970s oil issues in the US. Like, this leads to more instability. Now look, Europe's rich. They can cover these price increases, but the subcontinent or South America or Africa, they are not as rich as Europe, and they cannot afford these type of price increases. So we're going to see more and more instability around the world, not just in stock markets, but in political markets, geopolitical markets, and that is absolutely what's happening when we go through periods of instability. This is Germany's. So I'm just the price chart before was looking at all of Europe's electricity price. This is Germany's. This is pretty crazy. This is what German year ahead power price, right? What they're paying for electricity. This is France's right here. This is about a 30x increase from the 5-year average. This comes from Kyle Bass. So this is an absolute big impact to Europe. Europe has the money. Europe can handle this because they have it, but it's going to create a lot of headwind with the markets. It's going to create a lot of headwind with the markets. So here's kind of the takeaway. There was this agreement in the past where Europe would buy their natural gas from Europe, right? They have this relationship, this trade agreement. Let's trust each other. I trust you, Russia, to not invade me, right? Not put war again on the European continent, and I'll buy your energy. Well, that trust is done. It's completely done. Is it done for a day? No, it's done for more than a day. More than a year? Yeah, more than a year. It may be permanently. And I don't know what permanently is. 10 years, 20 years, 30 years. But Europe has basically said, we are going to figure out how to not buy any more energy from Russia. That means inflation is going to stick around longer. It also means instability will stick around longer. Right, so that means we're going to be in a period of inflation longer, or inflationary period longer. The other agreement that was going on in the world other than Europe agreeing with Russia to buy their energy, the US was agreeing to buy all of China's exports, or a significant amount of them, right? So you had the US and China with this agreement based on trust, and you had Europe and Russia based on trust. Well, that trust is broken now with China. So we are figuring out, the US is figuring out how to put together, build, create more things outside of China, outside of Asia, bringing them back to the US. That's also going to create more inflation. Right, think of supply chains. Think of how do we figure out how to build those chips on our own? How do we figure out how to build our own batteries? China was way ahead of the curve. They were figuring out how to build batteries and solar panels before we as a country was. So I'm going to land the plane here. So what this all leads to is consistent inflation. I do not believe inflation is going away. The data that's coming in says inflation is going to stick around a lot more, and that's going to create more instability in the stock market, and that's in fact what we're seeing. So the takeaway really is we're continuing to be in this period of instability, and we are starting to see cracks throughout the globe. In Europe, it's energy and natural gas. In the US, it's real estate. In Italy specifically, again, they look like they may default on their bonds. So this instability is spreading throughout. Thank you so much for being in my world. Please let me know where you think I got it right, where I got it wrong. What did I miss? What am I not talking about that you think I should be? I don't usually talk about things that everyone else is. Otherwise, you can just read it and watch it from them. And also, too, if you have a comment, leave it in the comments. I read them all. I comment on all of them. And thank you for being in my world. I appreciate it. And I will see you on the next video. Bye.